Aaron, not only does inflation cause us to pay more for pretty much everything, it may influence the Fed to raise rates sooner, or the bond market, by the way, to do it for them if we don't have to wait for the Fed. What does that mean for stocks? Tie them together.
So a couple things. Obviously, financials are taking a harder hit, which is unusual this time, since normally yield curves and inflation generally is seen as good for banks, but in this case, because it's so far out and it's hitting the economy so quickly, that's hurting them. But I think the biggest impact right now, what we're really seeing is that it's hurting those small caps and mid caps the hardest. And they've been really stuck in this trading range since we saw this inflation, since your April worries. Small caps and mid caps have basically been trading completely flat. And so this in further inflation and further signs, all these new numbers coming out, means they're probably going to be stuck in another trading range for quite a few months. And we may not see them recover into their uptrend and break out of that trading range well until 2022, until we see these worries go away. Because obviously, when you're a smaller company, higher interest rates, higher capital costs, those affect you a lot more than when you can more easily process it when you're a larger company or you have a little more inflation protection. So these are the companies that are most vulnerable, and we're going to probably see underperformance for quite a few months ahead.
When we say higher rates, too, I mean, let's be clear, we're talking like 2%, which, by the way, would have been lower rates a couple of years ago, Aaron. But higher rates eat valuations. That's part of the problem. It's harder to own a company at 24 times forward earning with rates on the rise. I mean, that's the whole point.
Exactly. And that's what it's really about. We talk about, we justify these super high valuations for these stocks, particularly for these smaller cap stocks as well as the large caps. And all of that needs to come down. So we've seen the S&P 500, its valuation come down since April, since the spring, and it's been in a fairly steady downtrend. But if inflation and interest rates continue to increase, and it's been a pretty steady increase, it's going to need to come back to what we saw at pre-pandemic levels, which is more about 17 to 18 forward earnings versus the 20-ish times earnings that we have now. Now, that doesn't necessarily mean that we need to see a 15% decline in the market. It could just mean that, again, we might just see a bit more sideways action until the earnings start catching up. The E in the PE starts growing and therefore lowering the valuation.
Before we let you go, you're always great for ideas. Then give us a stock we can own in this environment.
Yes. So what can you buy when things are so expensive? So one stock I like is Salesforce. It really has exceptional growth over the next 3 to 5 years. It's really turned into one of these quality companies, exceptionally high margins. It doesn't have to worry about high borrowing costs, plenty of cash on hand. And, their inflation is really all about higher wages. So it's something that they can more easily process over the next few years. So that's my pick of the day.